All right, so there are two different questions, and one of which is preparing the journal entries, right? So we're gonna go through each item and prepare the entries for each transaction. So the first question was about, the first item is purchased $250,000 of materials on account, right? So when we purchase, we debit the materials control, right? By the way, either you can use control after whatever the item is, or you can just leave off and just say materials, okay? It's just to show you that it is one of the accounts when we are preparing a journal entry. So since we are purchasing on account, we are going to credit the accounts payable. Both of which is by the $250,000. Right. Second, we have purchased the cleaning supplies. So in this specific example, we have a company that bakes pastries. The supply here, cleaning supply, would fully support all different types of pastries and desserts, given that each pastry itself is a job to this company. So cleaning supply itself is gonna be usually a MOH, the manufacturing overhead, instead of being able to trace back to each different job. Okay, so we are going to treat it as if they are an MOH. But first of all, we need to account for the purchase of cleaning supplies. So we debit supplies. So usually you would have a different account for supplies rather than having it inside materials. So they purchased 10,000 and credit accounts payable. Oops. Okay. Step C is about requisition, $240,000 of materials and $9,500 of supplies, right? So as said, these direct materials, if it's a traceable cost, that we are going to transfer it right away to work in process, whereas for cleaning supplies, where we're going to treat it as the manufacturing overhead, we're going to transfer it first to the MOH control, right? So we debit work in process and we debit MOH, right? And we first of all, we debit work in process by $240,000 by crediting the materials control of the same amount. And for the MOH, we debit MOH by $9,500 and we credit supplies by $9,500. Right? And then for D, we have the employee costs. So there are 4 different things that we need to adjust. And first of all, let's use the wages and salaries payable as the way we combine all these. So we first credit the wages and salaries payable. And we lump all these 4 into this payable. Okay, so once you add up, we have $780,000. The way we're gonna debit is gonna differ by different cost type. So as for direct labor cost, we're gonna directly transfer it to work in process. For the indirect labor, we're gonna use the MOH control. And then for the administrative salaries and sales wages, you can actually have it as an SG&A, as a period cost. Or you can identify it as each as an administrative salary expense of 80,000 and sales wage expense of, this is 200,000, right? 80,000, right? Now let's move on to E. Okay, so E is where we want to account for the advertising expense of 3,000. Well, here there is a premise on implicit assumption in many different cases is where if you incur expenses, you don't pay directly by cash, but you pay on account, right? So you use accounts payable normally. So that's what I'm going to do here as well. So since advertising is not related to baking, the so-called production, it's going to be expensed as it's incurred. So we expense the advertising expense of 3,000 by crediting the accounts payable of 3,000, right? Now moving on to F. Property tax have two different types. 10% related to space, related to sales office. So sales is not related to production. This would be expensed right away as tax expense. And 90% is related to kitchen, so related to production. Property taxes are usually deemed as an MOH rather than directly traceable. So 10% out of 8,000 is going to be 800, which we're going to debit as a tax expense. And then for the rest, 7,200, we're going to debit MOH control. Okay. And then what goes in the credit? So this is also based on a payable, taxes payable of 8,000. Now for G, we have depreciation. Well, usually, normally, when we have depreciation, we credit the accumulated depreciation, which is a contra account for the assets, right? And that amount is $55,000. And it says that 80% is related to kitchen and 20% related to equipment. So 80% is the version that we're going to transfer as an MOH, right? So MOH debit 44,000. And the depreciation expense, which incur right away, let me just write it as deep expense, which is 11,000. Okay. And then H, we have insurance expired. So normally you pay the total insurance premium upfront, and then once a certain period expires, then you credit the prepaid insurance, which is the asset account that you debit upfront, right? So when certain period insurance is expired, then you credit what's called the prepaid insurance. So that amount is 15,000. And then it says that 90% is related to kitchen. So this is the MOH control. And the remainder of the 10% is going to be related to office equipment. So this we incur as an insurance expense. So we can debit the insurance expense by 1,500. And then the rest is going to be debited as MOH control, so 13,500. Okay, I is one of the most important part. Since we don't have much space here, let me do number 2 later. Okay, so I here is allocating the overhead cost to the production, right? So here, if we come back to the problem, it says that they're gonna allocate overheads based on direct labor hour, right? So we need to find the budgeted MOH as well as the budgeted labor hour, which happens to be here, right? So we first need to come up with the predetermined overhead rate, which is $150,000 over 16,000. That's equal to 9.375 per LH, which is the labor hour, right? And then we want to compute it by multiplying by the actual labor hour. And if you see the question, there is no direct labor hour that we can observe, but indeed we can use two different numbers, which is essentially the wage rate and the total labor cost. So given that the labor cost is calculated based on the wage rate and the actual labor hour, we can also compute the actual labor hour by dividing the 450,000 labor cost by the $25 wage rate, and that will give us 18,000 LH, right? So in total, if you calculate this multiplication, you will see $168,750. So once you have that, then we can proceed with the journal entry by debiting the working process of 167,850, and we credit MOH. Well, more specifically, it's the MOH allocated, which is the contra account for the MOH control, right? All right, and then for J, we have desserts costing $790,000 were completed. So we need to, out of the working process, we need to transfer it to the finished goods, right? So I'm just gonna use the abbreviation FG. So debit the finished goods by $790,000 by crediting the working process by $790. Right. Lastly, we have company generating sales of $1.8 million and the job cost $720,000. So this is the COGS. Once you generate sales revenue based on the sales expense revenue matching principle, the revenue expense matching principle, you have to incur the COGS right away. So since you're generating the sales on account, you need to debit the accounts receivable, which I'm going to use the abbreviation of AR, by 1.8 million, and you credit the sales revenue of 1.8 million. At the same time, you also need to expense the COGS by $720,000, and you need to credit FG, the finished goods, by $720,000. But of course, even though I understand AR or FG, in the midterm or final term, it would be better if you lay out, if you specify what exactly are these accounts, rather than using the abbreviation. Okay, now we are going to move on to the second question. Make sure to make your hands dirty and you have what's with you, beside you, before heading on to this question. Okay, so the first question is about calculating the amount of overhead allocated in the fabrication department and the finishing department. Okay, so actually, if you read through, the predetermined overhead rate for each department is already given, and here we are interested in May, and we also have those actual CABs for different departments in May, right? So all we need is these four numbers to come up with the overhead allocated in each department, right? first of all, for the fabrication department, we have $20 per MH, and the actual MH for May is 2,000 MH, right? So $20 times 2,000, right? And that's gonna give us $40,000. And then for the finishing department, we have a overhead rate of $16 with a CAB of 1,200 labor hours, right? So 16 times 1,200 is gonna give us with 19,200, okay? Now, since we have the allocated amount, we wanna compare that with the actual overhead. And if you see this sentence, we have the actual overhead incurred. So we're gonna use the 49,500 as an actual and the allocated overhead of 40. And that will give us $9,500 of under allocation. And then for the finishing department, the actual is 22,200 and the overhead allocation is 19,200. So the difference between the two of 3,000 is going to be the under allocation amount, right? So the total under allocation is going to be $12,500 under allocation. And this is what we want to adjust, right? So if we look at the number 3, we want to prorate, right, based on the account balance. So in class, I've shown you 2 ways to prorate, which is to use the MOH applied before proration or account balance itself. And this is using the second approach that I've shown you. And then the question is, what will be the balance after proration, right? So first off, we want to calculate the account balance percentage by each account. And we're going to use these numbers right here. Right? Like, for example, we want to first calculate the working process percentage by dividing the 50,000 by the sum of these 3, right? So if you calculate this, it will be about $500,000. So this accounts for 10%. And for the finished goods, it's going to be 150K over 500K, so 30%. And lastly, we have 60%. Okay. Then how much is the prorated amount and after proration balance? So for the working process, the pre-proration balance was 50,000. And then because it's under allocation, we want to add, right? And if you remember from the last slide, the under allocation amount was 12,500, right? So 12,500 times 10% or 0.1, this will give us 51,250, right? And for the finished goods, we have 150,000, right? 150,000 plus 12,500 times 0.3 is going to give us 153,750. And lastly, we have 300,000 plus 12,500 times 0.6. This is going to be 307,500. Right? And then actually for number 4, I haven't laid out here, but let's think about it. What would be the effect of writing off to COGS? Right? Since it's an under allocation, we want to debit, right? We want to debit the COGS by 12,500, right? So we want to increase the value of COGS. And the question here is, would it be reasonable to change to this simpler method? And actually, this is a subjective matter. This is your call on what you think is reasonable. But as I've shown you just some general guidance, a COGS is generally more optimal or more efficient if the either the over or under allocation amount is not quite substantial, right? So if you think about the under allocation amount here, it's only about 12,500 compared to the total account balance of these three accounts. So we can kind of say that under allocation amount is minimal, therefore we can easily change it off to the COGS. And of course, I've said that we should be more conservative, and we don't want to, game the system by reducing the COGS. So if it's an over allocation, it might be better to use the proration method, right? So this is your call on whether we should stick to the proration or to the COGS. Okay, so that was it for this session, and I will see you next class. Thank you.